Hello, welcome to 5 Minute a Day Trader. On this channel, we spend just 5 minutes a day trying to find some trades. And I try to come in every day, but typically I make it, 2-3 times a week, something like that. And the idea of this channel is to create a portfolio of short and medium term trades that are successful more than they're not, but at the same time doesn't require me to stress out and look at the market like every minute of every day, and sometimes I don't even need to look at it every day. So it's kind of somewhere in the middle of the boredom of buy and hold and the excitement and interest of like day trading. And I think that something else that is unique about this channel is just we deal with reality. I'm not going to prognosticate a lot and things like that. Now, with that in mind, it's been a couple of days since I've been. So let's just take a look through everything and see if there's anything worth trading today. I have quite a few trades on, and we're getting close-ish to expiration. So I'm hoping that some of these are going to be winning here pretty soon. So let's see where we're at. So I'm going to go ahead, I'm going to sort by alphabetical in my ETF watch list. I'm right here in Tasty Trade. You can sign up for Tasty Trade with a link in the description. It's a really great way to help out the channel. But I'm going to run through everything just to see kind of where things are at. We're going to take a look at what movement's been happening recently, and most importantly, what the IV rank or is of each underlying. And the IV rank is how high the underlying's implied volatility is compared to itself over the last year. So is it high compared to normal or low compared to quote unquote normal? Typically anything over 35 is a zone where we might want to consider selling some options. So we can see, let's jump into the markets first. So we got the diamonds here. They're up a little bit today, but you can see they've been kind of like all over the place recently, right? We've got this IV rank up in the mid 40s, so that might be something interesting. I'm going to jump down to the other markets quick. So IWM, that's the Russell. We can see that's really been going down recently. That's not going to be good for me because I got some trades to the upside in IWM. But so guys having a bit of an update today. 41 IV rank, and then the Qs, they are kind of similar-ish to IWM, and then the spiders. SP 500, similar again. Now these should be similar because they're all very correlated to each other. If we look at the correlation column, as I have it set right now, this is how each underlying correlates to the S&P 500. So the diamonds, which is the Dow, it's a 0.88. So 1 is, it's right in sync. -1 is it's the total opposite. But typically anything up here in the sort of 80s and above is getting to a point where it's like, it's pretty close. So you can see the diamonds is pretty close. IWM is close. The Qs are really close. So these 4 ETFs are in a lot of ways are following each other. So when it comes to putting on trades, we want to be careful that we're not putting on too many trades in correlated underlyings. Like that would be compared to, say, the euro here, FXE. This is a 0.18. That means it basically moves independently, at least over the last year, to the S&P 500. So what that means is that if you put in a trade in the S&P 500 and a trade in the euro, most of the time, they're not going to be affected by each other. So that's great because that means that you're not going to be hurt with all of them going down simultaneously. If I load a bunch of trades into DIA, the diamonds, and the Qs, and SPY and IWM, I'm basically creating the same trade because they're all going to move the same way. So I really want to be aware of things like that. So then we start to say, okay, which one should we put it on? If they're all going the same way, like why even look at them all? Well, that's, again, comes down to things like implied volatility ranks. So let's just take a look at the 30 delta and like the 44 day. So 45 days is typically a good zone to sell options. But as an example, let's see here, we've got the 33 delta in IWM. That's going to pay me $5.55 is a $400 underlying. So the Qs are not that much different in price, right? They have a lower IV rank. So this is for the 33 delta is collecting 550. Let's look at the 33 delta in QQQ, and you can see it's collecting a lot more. It's collecting almost $9. So it's like 40% more. Part of that is it's slightly higher priced. underlying is why we're there. But you can see the max loss, 44,000. So the max loss on IWM is 40,000. Yeah. So it's the risk is a little higher, but the amount you're collecting is a lot more. Let's look at the spiders, the same. So the 30, is there a 33 delta? There's a 33 delta. So that's collecting about the same as the Qs, but the max loss is much higher. So this is why we look at multiple underlyings, even if they follow each other. And the reason is to decide, okay, I want to put a trade on the markets, but I want to make the most money I can. So I can collect more money for less risk by trading in QQQ than I can in SPY today. That might be different tomorrow. So it's just something to think about. So if I were going to put a trade on, I might do it in QQQ. Another thing to think about is the actual price itself. So like how big is my portfolio, how much capital I have to work with. I have several different accounts that I work with. Some of them I'm not willing to risk $53,000 on a single trade. Now, it's keeping in mind that $53,000, that is if the S&P 500 goes out of business. Like if the S&P 500 goes out of business, we're talking the end times. Like you're gonna be worried about zombies or something. Who knows what's gonna happen? So this basically is not a situation we're going to deal with. And if it is, you're not going to be worried about your portfolio. Like you're going to be worried about like how many meals you have. So when we're looking at ETFs, particularly market ETFs, this max loss is really, not necessarily valid. That's one of the reasons that I like to trade ETFs. If we think about specific underlying, so let's look at, Tesla's been getting really beat up recently. If we look at Tesla here, and let's look at the 33 delta in Tesla, it's a $22,000 max loss. It's going to collect a bunch of money, right? Because Tesla, its volatility is very high right now, so the options are super expensive. But there's a non-zero chance that Tesla could go out of business. And this isn't designed to be political or anything like that. Whichever side of the aisle you lie on, Tesla's price volatility recently is because of Elon Musk, right? It's because he's such a celebrity, essentially. Like he can affect to the positive and the negative the price of his stock. So like if people were to turn around and be like, no, we're not buying Teslas, the company could go out of business. It could get bought out, or it could literally go bust. Like that's happened with businesses before. So this 22,000 max loss, it could be a real amount. Is it going to happen? Probably not, but it could. Where with SPY, this is not a real amount. Like, so if we're comparing, let's say IWM, because IWM's cheaper. Let's do the 33 delta in IWM, 32 delta. So it's about the same max loss as Tesla. You notice that you're not collecting anything like the same amount. That's because the volatility in Tesla is so high. The probability of getting to this max loss in IWM is essentially zero. Like if it did, again, we're talking like global cataclysm. It doesn't require a global cataclysm for Tesla to go out of business. So it's just something to think about. I picked Tesla because it's like in the news and all of that, but throw that on any particular company that you think of. Companies can go out of business where ETFs, typically are not going to go out of business. Let's take a look at the emerging markets. So this is low correlation to the SPY, but you can see it's kind of following there a little bit. EWZ is Brazil. This is one of the ones I do really like to trade. It does have a low IV rank right now. It's kind of a sort of coming off a more recent high here. The euro, I like to watch the euro, but I don't like to trade. I find the markets to not be that good in there. Like they're not very liquid. The metals, they're still way up at highs right now. I have positions on the metals that'll make money if the metals come down again. So I'm not going to add any more positions. But with GXJ, having this IV rank of 54, that could be a really interesting trade to do in there. Let's see. I have a position on in there, but it's like way it's at zero. I should probably close it out. Like if I were, for example, to think about maybe a $5 wide call spread here, collecting 73 cents. There's a 74% chance probability of profit and almost 80% chance I make 50%. And I'm not risking that much, $400 like on a single spread. So that could be an interesting trade there. I am not personally going to put that on because I kind of have that trade on already. But that's one I might want to put on if I was looking at the metals because they're high. So we looked through our metals there. Oh, IYR real estate. That's really in a range. So that could be an interesting one. I think the last time I recorded, I was looking at potentially doing a Jade Lizard in there. So let's say if we could do like we can even go down to this 91 put, which is 22 delta. And then I need to sell a dollar wide call spread right here. Could I do that one higher? Oh, yeah, I could even go higher than that. So this could be an interesting trade. Right here, well, as long as I'm actually, you know what? I know I'm rambling here a little bit. Let's see if I can move this put down. Yeah, there we go. So like I got this, I could collect $1. My max loss there is 8,900. This one will make money as long as IYR stays above $89, which is right here. It's right at that low. So that's an interesting one. Well, I mean, what would that be if I took off this call spread? Yeah, so basically, like if I take the call spread off, I collect less. So I have less movement. So I think actually I'm gonna put this on. So this is what's called a Jade Lizard. And the beauty of a Jade Lizard is that you can collect a little bit more money than you would just for the put. It's still a similar risk to the put, it's risk to the downside, but what it allows you to do, because you can collect more money, it makes your break even lower. So it makes my break even about 30-40 cents lower if I sell this call spread. But the other upside is if the underlying would blow through my call spread, like go up to way up into the stratosphere, that doesn't hurt me. The green on this chart shows where I make money. There's basically anywhere from 89 and above. I never lose money if it goes up. So that one's interesting. So let's go ahead and record that one because I've really been itching to put on an IYR trade. So we're here at April 2nd. And I know it's just getting pretty long, this video. So I'm going to jump right into tracking here in a second. So I'm going to put the 90 put with the 99 call and the 100 call, and I'm going to collect a $1.04, and so that would make my break even, give or take, $89. We'll just drop it there, and its expiration, I'm finally moving out into May, so it's 5/16 2025. So we'll go ahead. Okay, so I'm going to go with IYR today. Let me jump through my current trades and see how we're doing. So GDXJ, probably going to be hurting in this because I have a bunch of call spreads in GDXJ. But let's see where we're at. So first of all, I've got these two puts. I've got the 45 and the 46 put. Apologies for the police sounds in the background there. So I got 17 cents on the 45. And on the 46, I got 38 cents. Now, these are wonky right now. The markets are so wide because these are so far out of the money. So I'm just going to ride them to expiration at this point. I'm going to make 100% on these. So I'm just going to let them ride all the way. And then I've got the 59.64. Is that a GDXJ? Yeah, okay. The 59.64 call spread, which is 74 cents. So that one's doing good right there. Let's take a look at EEM. That's the emerging markets. Now I'm down to 15 days my expiration here, so getting pretty close. I got the 41.5. That's at 12 cents. And then IWM. IWM is, I think I was hurting in here, but I might be coming back now. I got the 194 and the 203. So the 194 is at $4. Oh no, I'm definitely hurting in here. 408. And the 203, that's in the money. Am I at my break even yet on that? I'm not sure. 764. So those are hurting me for sure. My break even is 199. So I'm still not at my break even. So I've got 15 days to go on these. As long as they stay at or above where they are, I'm going to be fine on those, even though I'm losing money right now. So I'm still not hitting my break even despite all the insanity in the markets recently. That's one of the things I really love about selling options is that you get so much leeway to be right. USO 67 and 68, so that's at 35 cents. And 68 is at 13 cents. Wide markets in there again. So some of these prices are a little wonky, honestly, because the markets are so wide, but that's okay. IYR, I've got the 91 put, and that's at 34. It's about the same as it was, interestingly. And then I've got these spreads in GDX. These are probably the ones that are hurting me. Let's see, 44.4. Yeah, this one's gonna be hurting me for sure. 44.49. That's at 213. Actually, it hasn't moved. It's so bizarre. My break even is 45. I'm sitting. I'm above the break even right now, so that one could hurt me. That one I might be a loser, which is a real bummer. But they're defined loss. These ones. And then I've got the 46.51. That's at $1.08. That's not moved either. The only downside to spreads is like sometimes they just don't move. Annoying. Okay, so let's see. I'm almost even right now, dollar for dollar. But we'll keep an eye on it over the next 15 days. Well, thanks for watching. Hopefully I'll see you again tomorrow. Be sure to like and subscribe if you want to see these in your feed. Thanks a lot. Talk to you soon.